When people talk about housing affordability in San Diego, the conversation usually starts with the price of the home. Homes feel expensive, prices feel out of reach, and for many buyers, the market feels overwhelming. But price alone is not what determines whether or not someone can buy a home. What actually matters is the monthly payment. I'm Steven Rotzart, and I'm talking about living in East County of San Diego, including cities like La Mesa, El Cajon, and Santee. Buyers are not approved based on a home's price or even their annual salary by itself. Lenders qualify buyers based on whether or not the monthly housing payment fits within affordability guidelines. That monthly number that lenders evaluate is what buyers have to live with every single month. This distinction is super critical because many home buyers assume that earning a certain amount of annual income automatically qualifies them for a certain price point of a home. In reality, lenders break down income into monthly figures and compare it against the monthly obligation. What matters is how much you make in a year, but how much income is available each and every month after accounting for your debt. Now, in San Diego County, median home prices are near the top of the market, often around $900,000 or even above. With today's mortgage rates and typical down payment, that price usually translates to a monthly housing payment between $5,500 and $6,500 a month. That payment includes principal, interest, property taxes, and homeowner's insurance. This is the number lenders use when deciding whether or not a buyer qualifies. It is not a theoretical number, and it's not a flexible number based on emotions or market pressure. It is actual monthly obligations tied to a loan. Lenders measure affordability using debt to income ratios. In simple terms, total housing costs generally need to stay around 30% of a household's gross monthly income. This guideline exists to kind of ensure that buyers can manage their housing costs, all while still covering all their everyday expenses and maintaining financial stability. This is also why lenders do not look at income isolation. They factor in car payments, student loans, credit cards, and other recurring debts. All of those obligations reduce how much of a monthly payment a buyer can realistically afford. When you work backward, the math becomes clear. So, to comfortably support a $6,000 a month monthly payment, a household needs to make roughly $20,000 a month in gross income, or roughly $240,000 a year. Based on those numbers, you can see it's $847,000. Now, what's interesting, and I've covered this in some of my other videos, is that it takes a lot of money to affect your payment a very small amount. Now, some people ask, what do you mean by that? Well, let's get into the details, because in this particular case, we're using 10% as a down payment. But if I go to 5%, you can see that the monthly payment does drop, but the amount of money that I had to come in with was only almost $40,000. Go on the opposite end of the spectrum. If we go all the way to 20% down, which is going to take almost $200,000 down, that means your buying power gets pushed to just over $975,000. This is why pre-approvals are built around monthly payments and not list prices. It also takes a lot of money to affect your monthly payment a large amount. Interestingly enough, two buyers with the exact same annual income can qualify for very different loan amounts. And this depends on their existing monthly obligations. One buyer, for example, may have minimal debt and qualify absolutely comfortably, while the other, with a higher monthly payment, may not qualify at all. So remember, that $800 a month car payment, that might be your problem to homeownership. This is why only on price or salary can be completely misleading when it comes to being a home buyer. That gap between income and monthly payment explains why many buyers feel priced out, even while homes continue to sell. It also explains why affordability feels disconnected from the headlines. Homes may continue to trade hands, but only a small percentage of households meet the monthly income requirements needed to support those payments. Affordability is not really about whether homes cost $1 million. It's about whether a household can afford the monthly payment that comes with that price without becoming financially financially strained. This understanding is important for both buyers and sellers. Buyers benefit from focusing on realistic monthly comfort rather than stretching to a price point that creates a lot of long-term stress. Home sellers, they benefit from understanding what buyers are not approved based on list price alone, but on a payment structure created by the price point in the current rate environment. Now, the bottom line is this: buyers qualify based on what they can afford each and every month, not the list price of a home or an annual income on its own. The monthly payment to true gatekeeper. You're thinking about buying or selling in East County, San Diego. You want a clear, honest breakdown of what your numbers actually look like? That's exactly what I'm here to help with. Every situation is different, and understanding your true monthly affordability makes all the difference before you make a move. If this was helpful, make sure you like and subscribe to the channel for more straightforward real estate insights. And if you want to talk through your options, you can reach out directly. I'm happy to have a real estate conversation and help you understand what makes sense for your situation. Thanks for watching. I'll see you on the next one.